Hello, and thanks for joining us for another segment of SBA's Training on Demand. This training is on SBA's insurance requirements for 7A loans in accordance with Standard Operating Procedure, or SOP, 5010-7, which is effective for all applications received by SBA on or after August 1st, 2023. SOP 5010-7, Section A, Chapter 5, Paragraph C, describes SBA's insurance requirements for 7A loans. SBA's requirements are the minimum that must be included, but lenders may require more than these minimums. Lenders must ensure all appropriate insurance requirements are included in the terms and conditions digitally submitted to SBA in eTran and in the lender's credit memorandum. SBA's regulation at 13 CFR 120-160C states that for 7A loans greater than $500,000, SBA requires hazard insurance on all collateral. So let's start by discussing the insurance requirements for 7A loans greater than $500,000. As we've already mentioned, SBA requires hazard insurance on all assets pledged as collateral for these loans. If the business is located in a state that requires additional coverage, such as wind, hail, earthquake, etc., the borrower must also maintain a separate policy for the state-required insurances. When real estate is pledged as collateral for the 7A loan, coverage must be in the amount of the full replacement cost. If full replacement cost insurance is not available, coverage must be for the maximum insurable value. Insurance coverage must contain a mortgagee clause or substantial equivalent in favor of the 7A lender. This clause must provide that any action or failure to act by the mortgagor or owner of the insured property will not invalidate the interest of the 7A lender. And the policy or endorsements must provide for at least 10 days prior written notice to the 7A lender of a policy cancellation. When personal property is pledged as collateral for a 7A loan greater than $500,000, hazard insurance coverage must be in the amount of the full replacement cost. If the full replacement cost insurance is not available, coverage must be for the maximum insurable value. And just as with real estate pledged as collateral, when personal property is pledged as collateral for a 7A loan that's greater than $500,000, the insurance coverage must contain a lender's loss payable clause or a substantial equivalent in favor of the 7A lender. This clause must provide that any action or failure to act by the debtor or owner of the insured property will not invalidate the interest of the 7A lender. The policy or endorsements must provide for at least 10 days prior written notice to the 7A lender of the policy cancellation. Next, let's talk about 7A loans that are $500,000 or less. Hazard insurance is required for all real estate that is acquired, refinanced, or improved with the proceeds of a 7A loan. The coverage must be in the amount of the full replacement cost. If the full replacement cost insurance is not available, coverage must be for the maximum insurable value. Insurance coverage must contain a mortgagee clause or a substantial equivalent in favor of the 7A lender. For non-real estate collateral, SBA requires hazard insurance in accordance with the lender's hazard insurance policies for their similarly sized non-SBA guaranteed commercial loans. Next, let's look at the requirements for marine insurance. When a vessel is purchased by proceeds of the loan, and is, therefore, the collateral on the loan, the lender must obtain coverage in the amount of the full insurable value on the vessel with the lender designated as mortgagee. The policy must contain a mortgagee clause providing that the interest of the 7A lender will not be invalidated by any act, omission, or negligence of the mortgagor, owner, master, agent, or crew of the vessel, any failure to comply with any warranty or condition out of the mortgagee's control, or any change in title, ownership, or management of the vessel. The policy must include protection and indemnity, breach of warranty, and pollution coverage. The policy or endorsements must provide for at least 10 days prior written notice of the policy cancellation to the lender. Let's talk about flood insurance. SBA's requirements for flood insurance are based on the standard flood hazard determination. The mandatory purchase of flood insurance is required by the National Flood Insurance Program, or NFIP, and the interagency questions and answers regarding flood insurance. For condominium and cooperative units, the policy must be obtained by the individual unit owner for the particular unit. SBA permits private insurance if it meets the same requirements as the standard NFIP policy. If used, the private flood insurance must provide coverage that is at least as broad as the coverage provided under the standard NFIP policy, including when considering deductibles, exclusions, and conditions offered by the insurer. Include an endorsement that the insurer must give 45 days notice of cancellation for non-renewal to the insured and the 7A lender. Include information about the availability of flood insurance coverage under the NFIP. Contain a mortgage interest clause similar to the one in the standard NFIP policy. Contain a provision requiring an insured to file suit not later than 1 year after the date of a written denial of all or part of a claim under the policy. And contain cancellation provisions that are as restrictive as the provisions contained in the standard NFIP policy. Borrowers must obtain flood insurance if any building, machinery, or equipment that is acquired, installed, improved, constructed, or renovated with the proceeds of a 7A loan is located in a special flood hazard area. The requirement also applies to any inventory, fixtures, or furnishings contained or to be contained in the building. SBA and lenders must notify borrowers that flood insurance must be maintained under the NFIP or comparable private flood insurance. Insurance coverage must be at least equal to the outstanding principal balance of the loan or the maximum limit of coverage made available under the National Flood Insurance Act of 1968, whichever is less. Flood insurance coverage must contain a mortgagee clause or a lender's loss payable clause or a substantial equivalent in favor of the 7A lender. This clause must provide that any action or failure to act by the debtor or owner of the insured property will not invalidate the interest of the 7A lender. The policy or endorsements must provide for at least 10 days prior written notice of policy cancellation to the 7A lender, or 45 days in the case of private flood insurance. New in SOP 5010-7, the life insurance requirements for the 7A loan program are very easy to understand and implement. For all 7A loans, regardless of size, lenders must follow their internal policy for similarly sized non-SBA guaranteed commercial loans. When the lender requires life insurance, the lender must obtain a collateral assignment identifying the lender as assignee that is acknowledged by the home office of the insurer. That concludes our training on SBA's insurance requirements for 7A loans in accordance with SOP 5010-7. Please refer to SOP 5010-7 for the complete list of requirements for 7A loans. You can find other training topics on SBA's Training on Demand page. Thank you for watching.